Hey everyone, welcome to the Red to Black podcast hosted by Warner and Mario. And today we are discussing FinTech, this beautiful, amazing industry. It's just so sexy. We should all just invest in it. Whoa, stop for a second. Before you invest in anything, always look at the underlying value. There's only one way to do that, and that's look at the accounting statements. So what happens when we look at the accounting statements of FinTech? Well, before I get started, we're discussing FinTech because of an article on Zero Hedge written by Satyajit Das, I think that's how you say his name, from Naked Capitalism, and Tyler Durden, not the real name of Zero Hedge, reposted that article on Zero Hedge. So real quick to get into it, investment in the FinTech, the untidy agglomeration of finance and technology has reached a record $91.5 billion. Double that of 2020. In the last quarter, there were over 40 FinTech unicorns, startups valued at over $1 billion. The sector now attracts around 20% of venture capital, but it looks remarkably like a repeat of late 1990s. Flashing tech boom. Anyone? 2000 bust? When investors made ill-fated bets on online finance. Mario, what's your take on this one?
There's this promise that they're going to someday be profitable, and as a savvy investor or as a shrewd investor, never accept that promise from these companies. Financial technology companies are in that space because the margins are high. There's some good quality businesses, but they've been around forever. They've been around a long time. I'll give you all the secrets, folks. It's Visa, it's MasterCard, it's American Express. Those have some of the highest operating margin of those businesses are some of the highest operating margin businesses in the entire world, in the entire globe. There's businesses that want to get into that space, but there's two problems, Warner. Is one, they don't make money and they don't pay to own them. There's just promise that someday they'll be profitable. Most of this stuff is junk. There's probably a few winners in there. There's probably an Amazon in there. It's just betting on which one's going to be profitable 20 or 30 years from now. It's speculation. It's guessing. It's not the game. It's not the wise man's game. It's actually a foolish game to go into.
A few red flags, and this will literally take you a minute, which we've talked about in other videos. I've talked about on my other channel, Red Black Academy, is go to the Yahoo Finance. And Yahoo Finance, just as a disclaimer, they don't always have the accurate 10K data, which is the annual report. But go to Yahoo Finance, put in the stock ticker of the company. So let's do that for Square, right? And basically with Square, you know what? Let me see here real quick, Mario, on the fly. Let's do a quick screen share if I can. You want to try that out real quick? Since we're
Sure.
Screen share. Let me know if you see it. Right?
Yep, got it.
All right. So here we are. Can you see the Yahoo Finance?
Yep, I got it. Okay.
So I don't know if it's coming up on the live stream, but guys, we're troubleshooting this. We're just starting. So if you can see it, if it's coming up in the live stream, when you look at the profit margin, it's 3.21%. Look at the operating margin, 1.9%. Our base minimum to get into a business is 20%. So if you look at companies like Oracle, database companies, Facebook, they typically have a gross margin of 80%, meaning they only spend 20% of their expenses to produce a good or service. Let's go down to the income statement.
Can we pause there for a second?
Go ahead.
Jump in here. If you're going to go into a business that low of margins, gross margin, operating margin, if you're going to go take that risk, what you want is a 100% guarantee that that's going to work out. So you can make money going into those really low margin businesses, but it's got to be like a utility. It's got to be a monopoly. It's going to work out. It's going to return investor capital. It's 100% going to work out. If you're going to go that low quality of operating income or that low of profitability on a company, it has to be a 100% guarantee that it's going to work out. What you don't want to do is take the type of risk that you're taking. People don't understand. They're taking enormous risk going into financial technology, and they're going into a business. Square, I mean, that's one of the best ones. That's one of the most hype around is Square. Correct, Warner?
It is, because here's why, and this is something that I'm not bashing Jack Dorsey, but I'm pointing out something. What we've done nowadays is it's like we've financialized, if that's a word, individuals like Richard Branson, Jeff Bezos, Jack Dorsey of Twitter, right? He's the founder of Twitter, and then he started Square. Well, Jack Dorsey has a record of building companies that make no money, but yet he's a sexy dude, man. He's built these big, massive businesses. He's aligned himself with the right guys. Yet, guys, that's not what makes you money. Align yourself with the sexiest entrepreneurs that are like the highest revered guys in the entrepreneurial universe, right? What will make you wealthy is what Mari and I are talking about, which is the margins on these businesses. And if you look at the income statement, 16.74 billion, and then the gross profit is 2.74 billion. You can do the numbers on that one. That's not an 80% margin. That's like almost a 10% margin. That is not good. You're spending 90%. So as this article talks about, there's so many hidden fees in these fintech companies that make them hugely, hugely not a great investment. And we're going to talk about that. So Mario, what are your thoughts as I delve back into the documentation?
Well, it's trying not to become deceived by manipulation from a personality. Trump has made a ton of money. Trump himself has become wealthy. Trump is a wealthy man, but the investors in Trump's properties, the investors in his businesses have never become wealthy. Jack Dorsey is an incredibly wealthy man. Elon Musk is incredibly wealthy, but the people who invested in those businesses have not become wealthy. What you have is with like Berkshire Hathaway, you have people who have become billionaires. You have multiple people who have become billionaires investing with Warren Buffett, in the 1950s, 60s. You have numerous thousands and thousands and thousands of people who become millionaires. What you're trading for this popularity, its popularity is, man, these investments don't make the actual investors wealthy. They make the founders incredibly wealthy. Elon Musk is one of the wealthiest men in the entire world. Tesla hasn't minted a bunch of billionaires besides Elon Musk. If you look at the people who have been rewarded and you compare Berkshire Hathaway to and I know these are completely different businesses, but Berkshire Hathaway rewards investors. Some of these startups, these IPO startups, they invest founders and early people that are early into the business that got a bunch of shares. But the outside investors, the retail investors, the institutional investors, the outside money has never gotten wealthy investing in these types of businesses. Look for the big winners. Like there was a gentleman out of Singapore, his name escapes me. He worked for Jim Rogers. He said making money, the best investments are like bending down and picking up $100 bills. They're big no-brainers. That's what you should be looking for, not the next Amazon, next financial technology. It should be like, okay, Visa, MasterCard, and American Express. Buy one of those wonderful businesses at a three times operating income. The 3x their average operating income, 3 times their operating income for 2021 or 2020. That's going to make you wealthy. But paying for this Square, paying for Twitter, paying for these businesses don't make any money. You're gambling that in the future they eventually make money. What are your thoughts, Warren?
Yeah, and one thing you're going to notice is the businesses that make money are straightforward, and they're straightforward over 20 or 30 years. And you can see that in the returns they pay out to the investors through dividends, or if it's a real estate asset, like my wife and I have, and Mara's eventually going to get into, or any other business. Any business is the same. Real estate, investing at the same. It's you produce a product, which is an apartment unit, or Warren Buffett, you produce a share, right, in ownership in a company, and it produces a return. Simple. If I give you 100, this is business simple 101. How much do I get in return? That's all business is. That's all you need to ask. If I give you this, how much do I get in return? Am I getting it from a profitable company, and will that company be around for a while? Those are the 3 things if you want to be wealthy. There's more, but those are 3 simple things you can ask. Going back to this article, first, disguise the true function. That's part of the recipe for a fintech company. So he talks about a recipe. A fintech recipe is simple. Take a function, disguise it, or digitize it, disguise it, toss in a little jargon, financial engineering, technological disruption, season generously with mystique. Nope, we want to avoid that. Add some high profile speakers or Fonny media endorsements. I don't know what a speaker is. Stir and then serve. So the first,
it sounds like a part of a cocktail out of Europe. I think it's something to add to a cocktail.
Yeah, so it's a cocktail, and if you have too many bad cocktails, see, well, I don't even want to get into that, but we'll
No,
get
but
into
there's
that
gonna be
later.
no, you can. There's gonna be massive hangovers. There's gonna
Yeah.
be some massive hangovers when these things, just like the 1999, 2000 tech bubble, most of those companies don't exist anymore. There is a few winners. I accept that there's going to be a few winners in the financial technology space. There will be. Picking those, being the person that picks the right one, it's so difficult to do, is to figure out what is the next Amazon. What is a company that didn't make money for 20 years, didn't make money for a long time, but you bought in really cheap and you held it for 20 years, and now you're a multimillionaire, you're a billionaire. That's very difficult to do. What's easier, what's almost a guaranteed multimillionaire billionaire strategy, is to buy wonderful businesses at fair or undervalued prices and just hang on and know that you're going to get wealthy. That's a much easier game.
Yeah. So going back to the example of going to the bar, we've all been there unless you don't drink. There's always the story of where you go to the bar and you see all these high-end liquor bottles behind you, but the liquor bottles are not full of, let's say, Stolichnaya, which is a really good quality, like average grade vodka from Russia, which I've had in Russia, great vodka, or like gin is, really high quality gin, like I forget the name of it, English gin in the square bottle, really good quality, really smooth, or a Clear Creek Distillery. These are all high end bottles of liquor. When you go to a bar and they fill the bottle with something else, here's the key differentiator. If you don't know what to taste, or you're drinking too much, which is too much speculation, and your taste buds are blurred, then you're not going to know that they're putting poor quality liquor in your drink. That's the same thing like these fintech businesses. If you don't know what you're looking for in terms of the financial statement, you're going to get deceived by the bartender who's feeding you what you think fintech, which you think is high quality shelf liquor, however you say it, but he's going to be giving you the well liquor. It happens all the time. It happens all the time in bars. But if you have a good taste bud, you'll go, no, that's bad liquor. Give me my money back. So that's what you, number one, know what you're looking for. So fintech companies, what do? This is what this guy's saying. First, disguise the true function. Exploiting disclosure loopholes, supply chain finance helps businesses treat borrowings as accounts payable on the balance sheet. Whoa. Okay.
Financial
So now
shenanigans. It's financial shenanigans 101.
accounts payable on the balance sheet
Yep.
rather than debt. So accounts payable would be like an expense, right? The expense, accounts payable, I think it goes over to the expense statement, right? As I remember from accounting, it gets credited on the right hand. So this is why you need to know your accounting, guys. Credited on the right hand side, that's the balance sheet, debited on the expense statement on the income sheet. Whoa. No, it's not. It's debt. So you see, they're doing these accounting shenanigans to increase their, it's just insanity. So improving liquidity and reducing leverage. Unfortunately, it leaves investors and creditors bearing bigger losses when the business finally collapse, as happened with Spain's Abengoa in 2015, Carrion in 2018, and NMC Health in 2020. BNPL is nothing more than unsecured personal finance. Buy now, pay later is what BNPL stands for. No, get paid now. This is what we're talking about, guys. Any company that's using shenanigans has no integrity, and they're glossing over the fact that they don't make money. You want nothing to do with that. It's like someone saying to you, like, hey, we're going to go bungee jumping. And they're like, hey, yeah, when's the last time you checked the cord? Oh, yeah, we checked it yesterday. But that cord's been on there for a year, and they haven't checked in a year. And you're looking at them, there's like phrase on the line. Oh, yeah, no, it's good. There can be a tolerance of like 90% of the line. No. It's just got to be 100%.
I took a course at Northwestern. I think it was called Financial Shenanigans. It was an accounting. It was to try to prevent Okay, so this is what happened. One of the executives at Enron was from Northwestern University. One of the guys wrapped up in that whole Enron scandal was a MBA or business graduate from Northwestern, and that gave a black eye to Northwestern for a little while in the media. So they created this undergraduate business course called Financial Shenanigans, and it basically it broke down a couple things. It broke down Enron. It broke down this huge HMO down in South. It was like Southern Health, and it broke down MCI, like MCI. They were all very similar how that they deceived people and basically creating financial shenanigans in their balance sheet, in their income statement, cash flow statement, to create liabilities, turn liabilities into assets, and say, oh, these were like sales, when in fact they're liabilities. We weren't generating income from the business. They were generating a liability. And the reality is all three of these companies, they could make the stock price go up. They could create financial. What they couldn't create was a bunch of free cash flow that went back into buying businesses, buying back shares, and paying dividends. That was impossible for all three of these. The commonality between all three of those scams or Ponzi schemes was they couldn't produce the actual free cash flow. They could do all sorts of shenanigans to make numbers appear good. The reality is, if you did the deep dive, they had no free cash flow to buy back their shares, to buy other businesses, or to pay dividends. And that's all these businesses that are they're scams. They never do that. You'll never see them be able to create the free cash flow to do those three things. And that's one of the reasons why Warner and I are pushing you into businesses that pay you to own them. It's extremely hard for them to be a Ponzi scheme or a scam.
Yeah, and on that final note, that's how you said it is where I want to leave it, because you couldn't have said it any better than that. Guys, I give you $100. You give me $100. Expect something in return. Cash flow from operations, not from debt and financing. As always, if you're not a subscriber, subscribe to the channel. Our request is that if this content was valuable to you, send it to at least one person or more. Like, comment, so the YouTube algorithm tells us to share this content, or tells YouTube to share this with the world. And then, as always, we look forward to connecting with you in the future.